back to Good Returns. I'm Matt here with Garrett. I'll lead with the S&P did in fact hit an all-time high. Brand new all-time high. What a difference 14 days makes.
Yeah, not a sentence that we would have thought to imagine 6 weeks
2
ago.
weeks worth of sweat off my head here, I'm sorry.
More than 2 weeks. 6 weeks ago, we were in the middle of a conflict. Oil was spiking toward 115. Markets had fallen almost 10%-ish. And now we're here.
Yeah. The week started with a U.S. naval blockade of Iranian ports. Oil surged above 100 overnight on Monday. Stock futures went lower, and somehow we have now ended on a record. Explain it.
We should
unpack
have
it.
some clackers or like.
We do have sound effects on there. But
we do have sound effects. I can't reach that.
Lean over and.
Before we get into most of that, quick note, as always, everything on Good Returns is for educational purposes. We may or may not be your financial advisors, and nothing we say is personalized advice for your situation. We're here to give you context, help you think more clearly, and feel more grounded when you sit down with a professional if you decide to do that. We would encourage you to do that.
Yeah, absolutely. Let's get with it. Last week, we were watching a ceasefire that both sides had confirmed. Immediately, that ceasefire was tested. This week, that ceasefire officially... I don't know what you would say. They went with a different strategy, so to speak. Ended up with a naval blockade. A lot of uncertainty over the weekend with the implementation of that. But in fact, it's whatever the market is seeing, whether it be a cessation of hostilities, a negotiated end to conflict for some time, whatever the market is seeing, it in fact did like. The S&P closed at an all-time high. So now this is our official start to the year of 2026.
Nothing before this counts.
Yes, nothing before this counts. We are now starting the year. April the 17th is the new year at Momentum Wealth Management.
The new year, yeah. Let's put numbers to it. The S&P gained nearly 3% on the week, traded above 7,000 for the first time since late January. The NASDAQ gained 5%. Thereabouts, and logged its 11th consecutive day advance and the longest winning streak since 2020. And now what we've seen over the last few trading sessions is what is referred to as a V-shaped recovery from the late March bottom, erasing a nearly 10% drawdown.
You heard it here first, folks. We predicted this. I'm just kidding. But it V-shaped recovery.
Disclaimer.
V-shaped recovery. I believe the third V-shaped recovery since COVID, if you include COVID. One was the first one last year and now one this year. So they don't happen very often, but we do have 3 instances of them happening in the past 6 years around this exact same time. How odd is that?
Yeah, it is very odd.
Yeah, very, very odd. Monday was a pretty good stress test. Of course, the overnight news of the naval blockade sent oil above $100, and the index in the futures, the stock market futures, lower. Market stabilized after a confirmation that non-Iranian shipping would be unaffected. The market made a judgment call pretty quickly. I mean, we watched it in real time. We were texting that evening and that morning, of course, about it.
As we did.
The targeted action did not, in fact, increase escalation, and we saw some pretty good turnarounds in the market.
Yeah, and then today, it's Friday. Oil actually finished the week lower than it started. Volatility continues to fall in almost every part of the market. The VIX is now below 20, which is kind of approaching its pre-conflict levels. Like to see that. Credit markets keep tightening, which is something we'll come back to in a bit, but all positive signs.
Yeah, it is.
Really constructive.
And we did, in fact, mention a few weeks ago, in all seriousness, about the VIX. The volatility index can be an interesting barometer of what is to come, both on the up and the downside. It's not an accurate predictor 100% of the time, but we spoke about when you see the VIX have a certain percentage run up, followed by a certain percentage drawdown, it's like 99% of the time, that marks the bottom. Whatever is the tailwind that brings back the bull market doesn't really matter if you're just looking purely at the technicals. But we did, in fact, see the VIX behave in a manner that would, in fact, have marked the bottom. And now looking back, it appears that to be the case. Sector leadership tells a very interesting story. We had growth and technology lead. So we had the NASDAQ come back into favor. this week, which was something a little we hadn't seen in the previous 5 weeks. Smaller companies did participate in the advance, but they did lag the NASDAQ. Defensive sectors and commodity-linked areas, energy, industrial materials, did in fact decline. So we had a concentration of the rally in kind of the big growth names this week, which is a kind of that's not really a trend breaker because it's just a week, but it was different, markedly different.
Yeah, I think the context there is that most of the first quarter, you had value stocks and smaller companies and international markets, even all that stuff we talked about last week, outpacing large tech names. It was kind of this idea of the rotation that we've been talking about for a long time. That dynamic has kind of reversed sharply since the March bottom. Growth has, like you said, overperformed value. Year-to-date gap between the two has nearly closed, almost. So it's interesting.
Yeah, the takeaway isn't that growth is back necessarily or value's finished. It's really that the year has seen kind of cycled through two distinct different market environments within a 4-month period of time. It's definitely
the old start to the year.
Yeah, it's definitely a great argument for why you should maintain a diversified approach and diversified exposure across different parts of the market rather than just concentrating on whatever had worked previously. And my, oh my, has the beginning of this year been a testament to that. We've seen it firsthand, and we like to brag a little bit in how we use data to help allocate portfolios, and picked up on this very, very early in late December as to what in all likelihood was going to happen with this market rotation. And I would definitely say that I don't believe that this is going to be the year of growth necessarily outperforming. I think you'll definitely have periods of time just because of how much it's drawn down. You could definitely have a period of time where you have some of your hyperscalers, your mega cap companies, your software companies that may have great percentage performance from a certain date within the year just because of how beaten down they have been. But I think when you go and look in totality on a rolling 12-month period, it may not be the case that sector as a whole is going to be the outperformer this year. Yeah.
And you also have sectors that, to your point a minute ago, they kind of lead on the downside and to the upside. A lot of times that is semiconductors. A lot of times that is tech. So, And
people are trying to figure out how to price some of these tech names. If you think of companies like Micron, that is a tech company, and it's got some pretty volatile price movements, but more and more we're seeing that priced almost more like a commodity, because memory is becoming a commodity. So you're having the market really having to figure out how do we price some of these companies, because AI has changed so much of their business model.
Yeah.
And
then you have companies like Allbird who announces their AI pivot and their stock goes up 800%.
Yeah. You want to know how to ruin my day?
It's a real problem. They really have to figure this out.
This is how you ruin my day. You're sitting at the office, you're working earnestly on behalf of your clients. And then your business partner says, "Hey, look at this ticker." And you pull it up and it's up like 5,000%. It's like,
wasn't that
I want
much,
you
but
to tell me
900%,
wasn't it?
Yeah. Well, it didn't close
It's
out
like,
that.
okay, you need to tell me to look at this ticker yesterday.
Well, there's no way to know that
Not
because it's
today.
a shoe company it's a bankrupt shoe company. And they made a pivot. I think another company just did that yesterday, or maybe today they announced that, and this sort of the same thing happened. We've gone a little bit of time without that happening, but this was happening more frequently at the beginning of this whole AI craze, where people, they had serial companies putting AI in their name and getting a lot of investment from that. So, I mean, it's just...
Well, it shows you that liquidity is in fact... Liquidity is still in the market. And I hold the belief that it's increasing.
Yeah, but you could also say that desperation is still in the market. I mean, that screams like a desperate act. If you're willing to...
A bankrupt shoe company says, we're going to pivot to AI. And I'm well, what are you going to do? Have you seen how hard it is to build data centers? Right?
They laid out what they're going to do.
It's like
time will tell.
Yeah.
I do want to talk more about the V-shaped recovery, though. But first, we'll talk about bonds just being flat for the week. Longer maturity bonds modestly trailed. And that's really kind of the muted story in the bond world is kind of a story worth telling. We're going to get into that in a little bit, but it's a good sign of confirmation for other areas that we're looking at. We've also talked about that. But let's talk about when people say V-shaped recovery, if we're talking about that with a client or if somebody's listening, what does a V-shaped recovery mean, and why is it something special? Why do we pay attention to it?
So a V-shaped recovery is when markets fall sharply. I mean, just take a piece of paper and draw a V on it, right? Markets fall.
Bring your
the whiteboard.
It's not a board. It's not a whiteboard, but it's
what's my whiteboard?
like a giant Post-it.
My Amazon whiteboard, my $12.
We'll bring it over here and we'll sit it in the wall in the corner.
Is when markets fall sharply and then recover just as sharply. In this case, the market fell roughly 10%. If you're looking at the S&P market weighted index, fell 10% over about a 5-week period. And then within 11 trading days, it was all recovered. So it's a kind of a V drawn by your 3-year-old, really. It's not a perfect V because you had a 5 weeks down and then 11 trading sessions go up.
Like a
check mark.
Yeah, like a check mark.
Yeah, check recovery.
Well, I mean, what is significant about it too is not just the speed, but it's what it tells you about the conviction of the investor. The market didn't gradually drift back; it snapped back decisively, which kind of suggests to us that the investors who had patience to hold through the sell-off were rewarded quickly. And maybe if you moved to cash or if you moved to a more conservative position, you had to decide whether to chase the recovery or wait. And some people may still be in that particular area right now.
Yeah, we'll get into that in the planning room today because, new all-time high raises a very natural question for a lot of investors, and we'll dig into that here soon.
Yeah, well, let's get into the. We're going to talk just about 3 things that investors need to know. Normally, our investor note is 5 things, but we're gonna kind of shorten it to just the 3 that we think are really worth getting into. But the first is we just talked about at the beginning. S&P 500 is at all-time highs, but what does that actually mean?
It is definitely a milestone. S&P above 7,000, brand new all-time high.
Let's see what it closed out at, because market has already closed by the time that we were recording this. Oh, you know what? I can't. Go ahead. I'll find this.
I can pull it up right here.
71.26.
There we go.
There you go. Real time.
Old news now. 7,000 is old news. New all-time high, and just honestly acknowledging, that before we start qualifying it. I mean, 6 weeks ago, for a lot of people, it was hard to imagine. Not for us, seasoned and steady-handed.
It's still pretty hard to imagine.
Steady-handed as we are, but it's a big deal. What a difference.
Well, I think there's a very specific emotion that a lot of investors may be feeling right now that's totally valid, and we should definitely give it a name. All-time high doesn't just feel good. For a lot of people, it triggers some anxiety because you get all the questions that surround that. Should I have been more aggressive during the sell-off? Should I have invested? Is it too late to invest? When should I invest? Is this the top? All these questions that come in that you and I both hear quite frequently. We have conversations with clients and prospects all the time about that. And we kind of have a certain way we frame that. We talked a little bit about that a few weeks ago where we kind of take the S&P 500 and look at it over history and say, it's hard to pinpoint a time where it was bad, where it would be bad to enter. But, I don't know. What do you think about that? If you have somebody comes and says, hey, is it too late to invest now? Is it the top? Should I wait for another pullback?
They're understandable questions, but they're the wrong questions. Very bluntly, just to put it very bluntly, they're the wrong questions. The data does not support the conclusions that people draw from those questions and where those questions lead you to.
Yeah, a lot of people have a hard time understanding that all-time highs in and of themselves are not necessarily things to be concerned about. There's not cause for concern. S&P 500 has had many, many all-time highs over its history. It's every time it gets to an all-time high, every time it gets higher and higher. The data on what happens after an all-time high is not particularly scary. Historically, you've got forward returns in the year after an all-time high are roughly in line, and there are actually some studies that say slightly better returns than from any other starting point. It's kind of a piece of data there that's interesting.
The intuition that people have, and this really goes back to the Depression and how powerful of the multi-generational psychological impact that the Depression had on people is was profound. It is beginning to wane because now people with so much access to data and seeing everything in real time, and they have a very close, intimate relationship with investments, even if they don't realize it because of their 401k. It's there, it's tangible. They see it, they touch it, they participate in it. And so it's that people are much less they're not as prone to panic as they used to be. But generally it's, well, if it's at an all-time high, you know what that means? It's going to fall.
Yeah.
It's a recency bias. It's the thinking that somehow there's a gravitational pull and a necessity.
It has to happen.
That it has to happen. While at the same time holding the same view that prices over time must go up. Right.
Yeah. Kind of conflicting.
That is two conflicting and contradictory assumptions that both cannot be true. You can't have prices. Well, I know the value of dollar is going to go down and prices of everything's going to go up over time, but I also know the market's going to go down. It has to go down. Well, those two things are in direct contradiction to each other. Markets do not work that way. They do trend upward over time for several reasons that we can always get into in a different discussion. And new highs are a feature of a healthy long-term market. It's not a warning sign. It's the exact opposite.
Yeah, and it also doesn't mean that a correction couldn't happen.
It just did.
It could always happen. It always can. But
not
the
really
fact
a correction.
That we're not, it wasn't a technical. Well, it was in some sectors was a technical correction. I think the Nasdaq had a technical correction, but it's not in and of itself a reason to be concerned just because you see the tickers across the news when you're watching, say, markets at all-time highs. That's sort of like, like an old wives' tale or something maybe is where that has gotten into the zeitgeist that, oh man, you better be careful. Reached all-time highs. You better be careful. And it's just it's not supported by the data. No,
absolutely not at all. This is definitely a meaningful record. Investors that held through that have been validated in sticking with their retirement plan, their 401k strategy, their Roth IRA strategy. If you're new to investing and you held through these difficult weeks of news and definitely uncomfortable headlines, you're now looking at a portfolio that has rewarded you from that endurance. And that's great. It's not luck. It's how long-term investing works. It is now you're seeing it in real time, especially if you're new to investing, you're seeing it in real time that the portfolios are doing exactly what they're designed to do, and you're being rewarded for that patience and endurance.
And it doesn't make it any easier to live through that, though. It's still difficult. You still don't want to check your account values. You still look at, you may have some anxiety over the pullbacks. But this is why we always talk about the fact that we look from a standpoint of decades over days. We're not looking really at the days. We're looking at the longer term, especially when we're looking at retirement and needing income and all that kind of stuff. We're looking at a very long-term period of time. You're always going to have short bursts of volatility. You can find those anywhere, and they happen quite frequently. And a lot of people forget how frequently they happen until the next time they happen. And they're like, I can't believe this is happening. And you're like, it just happened last year. Like, it's the same thing. Like, it happens frequently.
Yep.
Then we get over it and it falls.
Yep.
I mean, it passes. The question of what to do next while we're at a high is when we're going to tackle in the planning room. I think it's a question on a lot of people's minds, and we'll talk about that in a minute.
Yeah, it's worth taking interest in. And so we'll walk you through the right way to think through this and what we're doing and how we think about it.
Yeah. Well, we have a little bit of an update here because when we wrote this episode, the Strait of Hormuz had not been opened yet. And before we started recording, it has now, by all accounts, been opened. So the question is kind of still relevant. I mean, we're going through a lot of weird elements in the market, geopolitical events, things that are increasing uncertainty. All of this kind of swirling around us, and how is the S&P 500 at an all-time high? When you look around at all the stuff that's happening, how can that be the case?
Markets don't ever price current goings-ons, and that's paradoxical to an extent because you see a headline, you see the market down. Generally, what happens is the market.
Yeah, that's true.
The market is attempting to price in several potential outcomes, and then people write headlines about it, and then frame the movements in a certain way that may or may not be entirely accurate. What the market does, and is very good at doing once you get out of the day-to-day time frame, is pricing in the expectations about future events and future conditions. So the market's expectation, this week really reflected how the risk premium has moved. And now you have more risk to not be invested than to be invested. That's really what it's telling. It's telling you the worst case scenario the market is viewing is less and less likely by each passing hour.
And that goes back to the VIX that you were talking about earlier. Spiked above 30 during the conflict in March, back down below 20. That's not a small move. That's the options market saying the range of expected outcomes, like you talked about, is narrowing. What we expect to happen is narrowing. It still doesn't mean it's going to happen exactly like we think it's going to happen, but the options are fewer now.
Yeah, it's very interesting. There are several things that are saying that. We have spoken about on previous episodes through all of these events that the peak oil consumption thesis seems to be holding true. Even with everything going on, we were still looking at structural oversupply. That is, the market is digesting what people have been saying for a couple of years, and they're digesting it to be true that the oil market is definitely more dynamic in its ability to adjust to shocks, and the consumers are more dynamic in their ability to continue their day-to-day activities with said shocks increasing or decreasing the price. And that's a testament to many things, but regardless of kind of the second and third order, knock-on effects that you think about, it's just, I think that this event probably really underscores that oil is going to be less and less of a major market driver one way or the other over time, because it's just very interesting. History will have to write it, and we'll have to look back, because 5-6 years from now, you'll be able to kind of tell. But so, yeah, commodity markets, oil markets are telling you one thing. Credit markets are telling you kind of the same thing. And, the extra yield that people get from buying, say, corporate debt versus U.S. Treasury debt. So corporate debt has risk, because if the company goes belly up, like the sneaker company you were talking about, they can't pay you, right? You can't get blood from a turnip
unless you pivot to AI.
Pivot to AI somehow, magically get new market financing and pay off the old debt and have new AI bonds. Whereas treasuries are backed by the government and backed by the taxpayer, you're going to get paid. So that extra yield that the risk premium on a corporate bond versus treasuries is a measure of how much compensation an investor needs for having on any of that risk. And that's been tightening, meaning that the gap between the two is getting smaller and smaller. And that convergence matters. It probably matters more than the oil story and the commodity story. It's pretty important.
Yeah, we think of risk premium kind of like an insurance premium. So when things feel dangerous, investors kind of demand more compensation for taking on risk. And that's the premium going up. And then when things feel safer, they accept less and the premium falls. And right now across stocks, bonds, and really all the volatility measures, that we're looking at, it's pretty clear the premium is falling, and multiple markets are telling us that at the same time, which is what gives us, again, last week we talked about it, the ability to say, this is encouraging to us to know that, and we're getting other data points from, I don't know, the data points that we pay for. We're looking at the market data points themselves.
Yeah.
All of it's kind of converging to the same thing across multiple sectors. It's not just that the S&P 500 is doing well and the NASDAQ is not. It's all kind of going at the same time, which again is encouraging from our standpoint.
It is. It's very interesting to see, and there's caveats. Obviously, things may not play out exactly as you would predict or think that they will, but there's definitely a significantly lower probability in any measurable way that this bull market is not, ripping and roaring and ready to go. And even for bondholders, that credit the credit spread tightening, your price of your bonds is going up, and now with rate cuts back on the table, you have your treasuries are also going to appreciate. And when rates go lower from the Fed, treasuries follow. Guess what happens to that risk premium? Because now there's a gap, it shrinks. So prices of corporate bonds go up as well. So
What's another sign of risk on?
yeah, 100%. 100%.
Well, let's move on to the earnings season. We'll just say that we did talk about that last week, about the banks having earning calls and things like that and what to watch out for. We talked about not looking for just the headline numbers, but rather looking for their forward guidance. And then we get some results.
Yeah, I mean, the results started coming in, financials leading the way, kind of the TLDR, strong quarter, and gave their honest take on what's to come next.
Yeah, they did have a genuinely good first quarter. Market volatility actually kind of benefits those certain parts of that structure because more volatility generally means more activity, which means more revenue, deal making and advisory activity picking up, and consumer credit remained healthy, it looked like. And on paper, you have a solid set of results. So we'll be looking for that.
Yeah.
To kind of trickle its way to the rest.
We can look at highlighting, one signal when you strip away the trading revenue boost, which is, like you said, tied to volatility. The underlying picture is pretty solid. I mean, it's not anything to listen. I don't like sitting around listening to earnings reports from banks. I will I will read transcripts and earnings calls for other companies, but banking just is not very interesting to me. I'm gonna go ahead and tell you. But you can read the tea leaves, and it's interesting to some. But the confidence level you get in kind of listening to what these bank CEOs are saying can be important. It really can be. It can bore you to death to go through the earnings transcript, but nevertheless, the underlying picture is definitely solid. Consumer credit is healthy, which means people are paying their bills. We're not seeing any significant increase in defaults. Business lending is in fact active. So companies are still investing, reinvesting, and that's a good solid foundation. And I predict more of that to continue if and when we see the 10-year follow the Fed and a lower trajectory. That 10-year really affects business lending.
We don't have to wait much longer for that. We have, I don't know, ostensibly, whenever
we'll see.
gets in.
Yeah, we'll see. But I know that the 10-year is a big deal for business lending. It really is.
Yeah, I mean, banks have an interesting insight because they have a view into the economy that not a lot of other industries have, because they have consumer spending, you've got business banking, you've got credit card balances, mortgage activity. They get to look at all of it. And so when they kind of flag things, it's interesting to look at. But they're flagging, for the most part, future risks, not really a current problem. Fundamentals kind of look okay right now. Questions whether they stay that way into the future, but they're keeping an eye on it. We will also keep an eye on it, and I would be interested to see other earnings calls where you have people reference that as well. This is just the first, so we've got plenty more to come. Yeah,
we got consumer companies, industrials. So consumer companies, think Coca-Cola. Industrials, think U.S. Steel, Dow Chemical, et cetera, et cetera. Then we have retailers. Retailers are always very interesting, because you get a lot of meme quality type retailer stocks, and it's interesting things can always happen around those earnings releases. So they report next, and we'll start to look at how the oil shock has or has not affected consumer spending, and kind of where that put businesses, that Americans really interact with on a daily basis, how that really affected, how was Starbucks affected by people paying a little bit more, et cetera, et cetera. So the banks were the opening act. We will get more detailed information coming soon. So let's look at the planning room that we have for this week. And a question a lot of people are asking after a week like this one is, should I be investing when the market is at an all-time high? And what does it actually cost you to wait for a better entry point?
It's a good question.
A pause. It was a pause, dramatic pause.
Dramatic pause.
Yeah. So, this is kind of a very on-point topic, obviously. And if I did not have the experience that I had and that we have, it's a natural question that would come up. Watching everything unfold is if it just hit, if I'm not paying attention and I just see a headline, I'm scrolling through, I'm doom scrolling at midnight, and I see market at an all-time high, and I'm like, man, I don't know about my 401k up in my contributions.
Usually you see that when you're doom scrolling, it's like an image of like catastrophe in the background and maybe some gold bars. Markets at an all-time high. That's typically where you see it and how you see it when you're scrolling at 12 a.m. Sorry, didn't mean to interrupt you.
No,
I thought that was a
it's
funny
people,
visual.
Yeah, as people see it, should I wait? Should I wait?
Yeah. Yeah, it's a common question in investing. One of the most reliable traps, really, because waiting for a pullback sounds logical to some extent. You buy low, you sell high. But if it's high right now, maybe you wait till it gets lower. Hard thing to do.
Yeah. Well, let's look at what the data.
Concept.
Let's look at what the data actually shows here.
Yeah. Well, if you look at historical S&P 500 returns and you sort them by whether the market was at or near an all-time high at the time of the investment, what do we find if we do that?
You will find that investing at all-time highs has historically produced returns that are in line with, and now here's something very interesting, and in some studies better than investing from any other starting point. So the intuition that high means it's about to fall is absolutely 100% not supported by the evidence. And you want to know, like, just a simple, easy way to look at it?
Sure.
The market's at an all-time high.
Yeah.
Right? Meaning that last year when it was at an all-time high, and you're like, I don't know if I should invest now, but now it's at an all-time high.
Another all-time high.
Which is higher than the last all-time high.
Yeah, markets reach new all-time highs as a normal part of the long-term investing process. A new high isn't a mountain peak. It's like a point on the trajectory on the way up. Investors who waited for a pullback before each of the hundreds of times the S&P reached highs would often have waited a long time. In many cases, the pullback they were waiting for came after another 10, 20, even 30% of additional gains. So that's the other kind of
absolutely.
Trap there.
The math of regret is asymmetric. If you invest at all-time highs and the market drops 10% shortly after, maybe not fun, right? It's recoverable. But if you wait on the sidelines and the market goes up another 15% before it pulls back 10, you've missed gains that more than offset the dip you were trying to avoid. So you've made two hard decisions. Excuse me. that Coke Zero got me. You've made two hard decisions instead of one. And so, yeah, I mean,
well, we could put some numbers to it. Put some real world numbers to it, so there's not as an abstract of a concept.
Well, it's what researchers call missing the best days, right? And this is where it can kind of get hard if you're not using data to really help inform your tactical allocation decisions and what sectors and what assets that you're holding. So, if you're fully invested and you look at your annualized return over a long period of time, we love to use the equal weight S&P. You're looking at about 10%. And that's what you hear a lot of people, Dave Ramsey, others, influencers that are out there. It's that low double digit.
Yeah, I think Dave's a little higher than that.
Kind of average. But 10% is really what you really see. So then if you go back and you say, well, if I miss like X amount of the best trading days, your percent of returns would really drop by doing that. And so that's where you really got to underscore, when you're making your tactical allocation decisions and you're trying to figure out, okay, should I be holding more T-bills right now versus equities? You still have to have an element of staying invested and really understanding that how you allocate needs to be more determined on the data of the markets and where you're at in your life and not really determined by the headlines, because that can lead you down a road of having diminished returns over a long period of time. It's not to say that risk management and being very thoughtful about whether or not you should or should not be 100% invested and experience big drawdowns, right? That's why we have different portfolios. That's why you have different tactical approaches. So you can solve for that by understanding the strategy you're in, where you're at in life, the effect that big drawdowns can have on your retirement. But you should not use headlines and just simple price movements in the market to determine whether or not you should or should not be a growth investor, or whether or not you should or should not have continued exposure to certain asset classes. So it's very interesting, and there are nuances to it. So we don't want to,
you don't want to have blanket coverage.
Yeah, you don't want to have blanket coverage, but it's always good to have in your mind that you got to have a strategy and you got to stick to it, even we're kind of regardless of what the headlines are saying, because that's when you're going to win out. And whether or not that strategy is an equal weighted approach or a market weighted approach or a small cap approach or a 50% stock, 50% bond approach. You need to develop a strategy that's good for where you're at in life, your income, when do you need to take your retirement paychecks, and get on that strategy and stick to it. And don't really worry too much about this or that and changing and jumping out of the frying pan and into the fire, because the data shows that's how you get burned.
Yeah, in the short term, because the best days in the market tend to cluster around some of the worst days. And so that's just how it happens. Biggest single day gains often happen during periods of high volatility. Investors who may have moved to cash during that short term period of time don't really participate in that recovery. And that has, effects that continue on down the line, exponential effects.
Agreed.
But to your point, the caveat here is that everything we talk about when we're looking at, even going back to the beginning of this conversation about the V-shaped recovery, everything we're talking about revolves around short-term volatility. And so this is an investor who may panic during a rough few weeks before getting back in. That's what the data argues against, because it's very hard to do that. It's very hard to know exactly when to get out and exactly when to get back in. And a lot of times those people miss it, and they miss it in a pretty big way, because they're always kind of second guessing. Should I get in now? Should I get in now? Should I get in now? I'm going to wait for a pullback. Market up 20%. I'm going to wait for another pullback. Market up 30%. When all the while you could have been in that. But this is not a situation for something that is legitimately extended bear market correction, a situation in time where economic conditions are deteriorating, you have valuations compressing, you have a drawdown playing out over maybe months or even years. This is different. And in those instances, a deliberate planned allocation to cash can actually serve a real purpose. It can stop or it can reduce at least volatility. It can preserve the capital that you might need for the near future, and it actually can give you dry powder to pull the trigger on meaningfully lower price data.
And that's why, if risk management is important to you, you should work with somebody like us, momentumwealth.us, shameless plug. Because, we are big proponents of risk management, but it has to be data-driven, and it has to be a proven process that will produce returns for you at the rate that you need to compound your wealth and produce income while keeping an eye on those max drawdowns. So you're exactly 100% right. There are periods in time where, again, your tactical allocation, how much cash are you holding? What's our sector allocation? How do we deal with a momentum, the technical term momentum investing to get better risk reward metrics during pullbacks? Those are all important questions that you need to work with a professional on, so that you can have access to those strategies.
And just because you have a risk mitigation strategy or an overlay that comes into the portfolio and may trigger, raising some cash or selling out of certain sectors of the economy, that doesn't mean you're going to miss any losses. I mean, you could have, maybe, I don't want to put a number on it, but you're going to have a little bit of a loss in that situation because you have to have the data come in, but you're trying to save yourself from the greater losses. So it's not like a situation where you could say, well, I'm never going to ever lose any money because I have this risk management. It doesn't work that way. It would be nice. It's great in theory. Yeah. It doesn't work well in practice.
True risk management inside of a portfolio, when properly paired with forward momentum allocation strategies, is designed to produce you a better risk reward outcome. It's designed to give you a better investing experience relative to your risk tolerance, so that you don't have to go really high up on the risk scale and endure such large drawdowns. And so, those strategies, you're generally going to see sometimes a lag in certain extreme situations, and then subsequently 9 to 12 months, you begin to see outperformance again, which is what you would have been used to, say, if you were in for the previous 3 or 4 years, right? Used to outperformance. So those types, this is why working with an advisor is so important, because there are hundreds of different strategies that works for their situation. And when you find one, you stick with it and you trust the process. And what you'll find common across all of those, whether it's risk overlays, whether it's a momentum style, whether it's a static kind of a food grouping allocation. What you will find is that trusting the process and allowing it to play out is much, much more important really than anything else. And we're seeing that play out significantly year to date, just significantly. And, we love sector rotation as well. We think that, in what we did and really becoming more so than in previous years, more small, mid cap oriented along with value oriented at the beginning of the year. We are reaping the rewards from that, having small but meaningful allocations to commodities such as gold and digital commodities such as Bitcoin and Ethereum have played a wonderful role in giving good, risk reward metrics into the portfolios. So there are all types of strategies out there that a very good, honest, and transparent advisor will walk you through. But all of this is to say that the best time to invest if you're not investing is today. That's really what all this comes down to say. And there's all kind of cute charts you can look at and different ways to spin it. But
I think there's also a strategy for people who may understand that, like logically, that the best time to invest is now, but maybe maybe they don't want to invest everything they have. So, there are some benefits to, if it helps, dollar cost averaging, that sort of idea where you just go in a little bit at a time over time, and it tends to, work out best from a performance metric rather than, lump sum investing. A lot of people make use of this. If you do this in your 401k, if you do every paycheck,
your dollar cost averaging, even if you don't know it. Yep,
yeah,
that's right.
And so, you don't really think about it, but it does have a compounding effect. And so that may be a solution for somebody who may be on the sidelines and, is questioning. Maybe that's an easier pill to swallow by going in smaller amounts.
It's behavioral, because the real thing we'll get down onto here, because again, you can't really, you can't be fundamental enough to plant your flag on that the market changes and sectors going down versus up. I mean, that can negatively affect people. And you're looking at this, and if you're in the energy sector and you're going up and you go down, we have clients that get oil and gas revenue that come in, and their paychecks can fluctuate from no dollars a month to you name it, right?
Yeah.
And so, the distinction really comes in is, intention and time horizon. And you don't want to make a move because you're scared, and then use that emotion. You're scared, so I make a move. And so now when I feel better, now I'm good, I'm going to go back in. That's really what cost people. So regardless of the type of allocation, if you're just in a static allocation in your 401k, or if you're using an active manager and being very forward thinking about, what sectors should we hold, what asset classes, because we want to get better returns for our risk, right? We're really trying to punch above our weight class in that situation. Or if you're wanting to be thoughtful about your allocation to cash, short-term instruments, T-bills, and maybe sliding the scale up and having more exposure to those during certain time periods, as long as it's part of a broader strategy that is designed for your time horizon, correct? And what you want to get in your retirement plan, what you want to get out of your retirement plan. So definitely you don't want to lead by emotion. You want to have a fact-based, data-based approach, regardless of what that is. As long as that fits what you're comfortable with and how the process works, you just want to have a strategy that is designed to endure all market conditions and produce that compounded annual growth rate over a multi-decade period that you need.
Yeah.
And if that means you make, let's say if the equal weight or the market weight S&P is averaging 10 points over 20 or 30 years. And let's say that even if that means some years you're going to make 25 while the S&P is making 7, and in some years you may make 9 or 10 while the S&P is at 13 or 14. What you want is that trajectory to be up and to the right over a long period of time in a vehicle that you're comfortable with.
Right. And you don't have to have all the answers. That's why people like us exist.
We have the answers.
Come into this environment where you have an advisor or somebody you trust that you can bounce these questions or scenarios off of, whether they be retirement, Social Security, any of that kind of stuff. We have those client calls weekly. We have prospect calls weekly. We enjoy it, and you got to find somebody who likes likes doing that.
Yeah. And again, we'll build out your strategy for you because not every strategy is perfect for everybody. We believe ours is obviously most perfect for most people. And we really enjoy and love what we do and think that we bring, that risk management and that reward. We really think that we look at it and balance the two very, very well between, we got to have volatility because that's the price we pay for returns. But at the same time, we do pay attention to risk because retirement is real and needing those paychecks are real and needing to make sure you have a sequence of returns that is designed to endure retirement, not a sequence of returns that's designed for, a 20-year-old to, invest $50 a month, right?
Right.
So you got to have all that planned out. And I will just say on the dollar cost averaging, I love dollar cost averaging, but the math is actually pretty clear. Lump sum wins. So I'm just saying, history show lump sum wins more often than not over a long-term time horizon.
Interesting.
Yeah.
I would have thought the opposite.
Chat GPT it. Fact check me in real time.
Should we do that? Should we fact check you in real time? Well, you know what? This is like this is inside baseball. We're pivoting our AI. We have used ChatGPT for a long time. We're pivoting to Claude.
Not I.
Well, you kind of are.
Not really.
I use
Grok.
Okay, internally for the business.
Oh, ChatGPT. Yeah.
We're kind of pivoting now, and so we've been using it a lot because we're like putting a lot of stuff into it. Nobody's going to be interested in this, but we're putting a lot of stuff into it. And so we're running against.
While you're doing this,
we're running up against caps, which is what I'm going to tell you that I will try it, but it's probably going to say I've used it a lot today.
Yeah, and we're paying for this, by the way. This is not free stuff, and it's still hitting the caps. And that's why I like Grok is you don't have any of that. They have significant compute power, but the Claude, I'll tell you, so far this year, Claude is winning with the quality.
Yeah,
there's no doubt. But I love using Grok. I pay for it monthly as well, and as a paying member, you do get access to some of the beta programs, or you get so many credits to use with their like higher echelon one that would be like $500 or $600 a month, and it's pretty good. But I will have to say, Claude, my wife uses Claude.
Does she?
It is better.
Does my wife.
It is better right now. Now in a week that may change, but it is definitely.
I don't know. I mean, they are.
It's definitely the best, and
they're continuing to release new things.
I saw this morning. They had that.
This is like we're getting way off.
They had the kerfuffle with the Department of Defense.
Yeah.
Right?
I saw that. Yeah, Anthropic.
But now, like, just today, they're meeting with the White House Chief of Staff over something because the Treasury wants to use because of that new Mythos.
Mm-hmm. Yeah, I saw that. I also saw them. There was a little bit of movement in Figma's stock price today because they announced a design module. So that'll be interesting. ChatGPT says that lump sum investing wins most of the time, but dollar cost averaging has a real role depending on behavior and risk tolerance.
Is that camera pointed at me?
Yeah, that one is.
So there we go.
All right. Well, whatever you decide to do, there's no wrong answer here. The wrong answer is not doing anything.
Unless you Matt GPT it, you may get the wrong answer.
GPT it, whatever. All right. Well, we've taken up enough of these people's time today. So let's turn it off here. That has been good returns. I've lost my place here.
Well, that's fine. Well, before that, just to reiterate, because we did talk a lot. We got into specifics, and just remember, always talk to a professional before making any major investment decisions. The right answer does always depend on your specific situation. But just remember to take emotion, and it's hard to do, but to take emotion out of the decision-making process and think purely about what you need in retirement, what's your time horizon, what are your goals, and how can you quantify your risk appetite, and then solve for that with a strategy that works at momentumwealth.us.
Yeah. I mean, I will add to that it's funny when we talk to people that are coming from like a 401k type environment, they may not have looked at their account in 10 years. And then they move into an environment where you have a managed account, you roll it into an IRA, you start drawing income from it. They're able to look at it. It's an app on their phone. They pull it up, and then they start getting like the nerves, especially when you're, maybe you're retiring at the beginning of, a war, a potential war, conflict in the oil. So it's just an interesting kind of paradox there that maybe the answer is just treat your IRA like a 401k where you don't really look at it a lot. And then, when you look at it when you retire, you're like, oh,
Hashtag blessed.
I got a lot in here, and I don't even realize it. Anyway, that's been Good Returns. Thanks for spending time with us. I hope it was good for you, good, useful information, good conversation. We hope it leads to good outcomes for you. Subscribe if you haven't. Share it with
And I'm
somebody.
still getting notifications. Things are up even after hours. Look at this.
Oh, hallelujah.
This is crazy.
Share this with somebody who would find value in it, and we will see you back here next week.
Until
Tell the
next
people
time.
Goodbye.
Yeah, absolutely. Take care. Enjoy your weekend. Be safe. We'll talk soon.
Goodbye.